Welcome to my channel. I'm Scott, and in this video I'm going to walk you through a process of valuing Palantir stock so we can determine if it's a buy or a sell. Palantir specializes in big data analytics. When you hear the term big data analytics, that refers to advanced analytic techniques against very large, diverse data sets from different sources. It conducts counter-terrorism analytics with the US intelligence and the Department of Defense. They also work with companies like L3Harris and Huntington Ingalls. Some of its clients are Morgan Stanley, Merck, Airbus, and Chrysler. An example of something they do is helping car manufacturers manage logistics and operations. Palantir also works with the National Health Service in the UK. Another entity they work with is the National Institutes of Health, which is a part of the US Department of Health and Human Services. They help fintech companies reduce money laundering from crypto transactions. The company is headquartered in Denver, Colorado, and was founded in 2003. Let's get started with the model. This is a large cap company, 32 billion market cap. They're trading at $15 a share, and they have 2.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a big negative in 2020, but it is positive after that, $346 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative each year, although the negative is getting better. Revenue is a sales for the company, and that nearly doubles from 1.1 billion to almost 2 billion. Here's the company's most recent income statement, the first quarter of 2023 versus the first quarter of 2022. Revenue is up from 450 million to 525 million. Let me give you a breakdown of the 525 million. Their revenue grew 78 million year over year, and that's an increase of 18%. Government revenue grew 47 million or 20%. Most of that growth is from the US government. They do business with other countries, but mainly the US. Of the 289 million of government revenue, 230 million is from the US. Revenue from commercial customers grew 31 million, or 15%. Most of the growth is from existing customers. 22 million of the 31 million of revenue is from customers they had at the end of the fourth quarter. That is offset by a decrease of 5.8 million from strategic commercial contracts. Of the 525 million of revenue, 336 million in the US, which is 64%. 50 million in the UK, 9%, and the rest of the world, 138 million, that's 27%. They're doing more revenue in the US, 64%, last year was 61%. Their commercial customer count is up to 280. 1 year ago it was at 184, so they added about 100 commercial customers. Total customers is 391, which is a growth of 7% from last quarter. But before that, the growth was 9% and 11% and 10%. It looks like this quarter they had their smallest growth. If you compare the 391 to the 277 from last year, that's a growth of 41%. Their cost of revenue is 107 million. Cost of revenue are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That's 417 million, up from 350 million. Cost of revenue in the first quarter was 13 million higher than last year, or 14% growth. They had a $4.4 million increase in payroll due to higher headcount, and 4.7 million in hardware, 3.5 million for field service representatives, and these increases were partially offset by a decrease of 2.7 million in stock-based compensation. So their margins are higher this quarter, they're 80%. The way to calculate gross margin, it's gross profit over revenue. It's how well you convert revenue into gross profit. Last year was 79%. And the growth is mainly due to lower stock-based compensation. These notes are from their 10Q. Let's look at their operating expenses. 187 million in sales and marketing, 90 million in R&D, 136 million in G&A. Total expenses 413 million compared to 390 million. Sales and marketing increased 27 million or 17%. That's mainly due to 27 million of payroll increase and 10.5 million in travel and office related costs. That's offset by a decrease of 10 million in stock-based compensation and a decrease of $3.5 million in marketing costs. R&D, the $90 million, that increased $1.5 million or 2%, because last year was $88.6 million. That's from increases of $4.2 million in third-party cloud hosting services, other IT costs, and office-related expenses. Also an increase of $4.1 million in payroll, once again partially offset by $7.5 million in stock-based compensation. General and admin decreased $6.1 million or 4%, so it's less this year than last year. It's $136 million this year. That's from a decrease of $16 million in stock-based compensation, offset by an increase of $8.6 million in payroll. Their gross profit is $417.5 million, minus operating expenses of $413.4 million. So they have operating income of $4.1 million. Last year they had a loss of $39 million. This is the first quarter they had positive operating income. So that's a really big step for the company. Positive $4.1 million. Last quarter they had a loss of $18 million. Before that a loss of $62 million. Before that a loss of $42 million. And as we know, in the first quarter of 2022, a loss of $39.4 million, which is right here, $39.4 million. Interest income of $21 million, interest expense of $1.3 million, other expenses of $2.9 million. The reason their interest income is so much higher this year than last year, because they bought a lot of US Treasury securities, because they had a lot of cash on hand. Instead of sitting on cash, they could earn a little interest. Last year in other expense, they had a loss of $60 million. Now they have a loss of $3 million. That's an improvement of $57 million due to a decrease in losses from our shares held in publicly traded equity securities. I'm not too sure what the securities are. Let me know in the comments if you know. I looked through the 10Q, I couldn't figure it out. But I did find this sentence. We have shares of publicly traded equity securities valued at $16.6 million. We have sold and may continue to sell some or all of our existing equity securities. These securities are often in early or growth stage companies that have minimal public trading history. So they're probably in penny stocks, really small market caps. Since their interest income was so high, their income before taxes is almost $21 million. Last year was a loss of $100 million. Taxes of $1.7 million, net income of $19 million. An EPS of 1 penny. Last year was a loss of 5 cents. They had 2 billion shares outstanding last year. Now they have 2.1 billion. They did have positive EPS last quarter, also a penny. But we saw earlier on the other slide, they had negative operating income. Similar to this quarter, they must have had a lot of interest income last quarter. But before last quarter, they had a loss of 6 cents, a loss of 9 cents, and a loss of 5 cents, which is right here, the first quarter of 2022. Let's look at the operating section on the statement of cash flows. Operating cash flow converts net income into cash. They reported an accounting profit of $19 million, but we have to add back the non-cash items. We have to add back $114 million of stock-based compensation. They actually generated $187 million of cash flow. Last year they had negative $100 million of net income, but they generated $35 million of cash flow. Let's look at the capital structure. $2.7 billion of equity, $250 million of debt. They're 91% equity, 9% debt. And they could pay off all the debt with the cash on their balance sheet and still have $2.6 billion of cash left over. I gave them a WACC of 11%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $13 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $11 billion. We divide that by 2.1 billion shares. And we get a calculated stock price of $5. They're trading at $15, so they're trading at a 200% premium. It's a sell according to the model. Simply Wall Street is at $1.48. They think the stock is worth almost nothing. 12 analysts priced this stock and the average price target is $10. The low is 6, the high is 15. Another 13 analysts priced this stock and the average price target is $9. They say the stock is 39% overvalued. So there's a lot of consistency here. Everyone says it's overvalued. This is where the stock has been trading since they IPO'd. It looks like it started out at about $9. Then after about 3-4 months, it ran up to over 35. It never got that high again. That was around January or February of 2021. Over the next 12 to 15 months, it came down to below $10. And for nearly a year, it was trading below $10 until recently it had a big run up. And that run-up must be from when they reported first quarter earnings. They had their first quarter of positive operating income, and once again they had positive net income, because they had positive net income in the fourth quarter of 2022. There are 144 companies in the same industry as Palantir, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They don't spend too much on CapEx since they're a technology company, only $30 million. They have hardly any debt. They have a really good debt to equity ratio. They do have positive free cash flow between the median and average. They rank 10th in market cap at $32 billion, higher than the average. They don't have good price multiples. Their price to book is 12, so investors are paying $12 for $1 book value. We can't look at their PE because it's negative on a trailing 12-month basis. Really high price to free cash flow of 93. Investors are paying $93 for $1 free cash flow. And also really high price to sales. So based on the price multiples, the stock seems overvalued. In the past 12 months, they generated $2 billion of revenue. Since they recently went public, we can't look at their 5-year annual revenue growth rate. So to summarize, I have them trading at a 200% premium. They've been around 20 years, and they do seem to be growing, but it's hard to really quantify exactly what they do. I think that's the issue with a lot of people. They're a really stealthy company, but they seem to have really big investors backing them like Peter Thiel, and I know he usually picks winners. I rank their free cash flow 6 out of 10, their revenue 7 out of 10, and their ratios 2 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.